It starts with a puzzle that seems almost childlike in its simplicity, yet terrifying in its implications. If every country is in debt, then who, exactly, is the world in debt to? If all governments owe money, and if every national balance sheet seems to bleed red ink in one form or another, then some entity, some shadowy someone, must be sitting on the other side of the ledger. And so the question becomes a riddle that opens into a corridor of deeper riddles. Where does the money come from? Who lends it? Who profits? Who decides the terms of repayment? And what happens when the borrowers are nations and the lenders are everyone and no one at once? To the average American, the idea of national debt exists mostly as a kind of political football or the ominous refrain of fiscal doom broadcast during election years. But the reality is stranger than the slogans. Debt is not merely a number owed. It is the architecture of the world economy, the nervous system through which capital pulses, the vessel through which governments expand or collapse. And once you begin to trace the lines of credit, to follow the capillaries of lending, you discover something unsettling. No single institution or empire stands above the world holding its IOUs. Instead, debt is dispersed, everywhere and nowhere, owned by everyone and controlled by no one. The world's debt is not a ledger held by a puppeteer. It is a giant, decentralized web, a matrix of obligations crossing borders, currencies, industries, and generations. But before we unravel that web, imagine the world without it. Imagine a global economy with no borrowing at all, where governments pay only with what they have in hand, where a war or a pandemic or a recession receives no financial shock absorbers, where a bridge or a power grid or a school system must wait for tax revenues that may never arrive. In such a world, progress slows to a crawl, crises metastasize, and modern civilization, as we understand it, collapses into a rigid pay-as-you-go existence. Without debt, nations choke on their own limits. With debt, they expand beyond them. That is where the paradox begins. Debt is dangerous and indispensable. It builds nations, and it destroys them. It stabilizes the world and destabilizes it. And because nations are not households, because they can borrow in their own currencies, restructure, roll over, or refinance, debt becomes not simply an obligation, but a mechanism for power. So let us step inside this mechanism and illuminate it from within. The first misunderstanding to clear away is the notion that countries primarily borrow from each other in direct, bilateral exchanges, like neighbors lending cups of sugar. That world is long gone. Today, when a country borrows, whether it's the United States, France, Brazil, India, or Kenya, the creditors are overwhelmingly dispersed. Domestic banks buy government bonds, pension funds purchase long-term securities, insurance companies store national debt as a safe asset, asset managers add sovereign bonds to their portfolios, mutual funds trade government paper as a low-risk counterbalance to equities. In many nations, households indirectly hold their government's debt through retirement funds. In others, corporations park cash in government securities because they trust those instruments more than banks. The myth of country A owes country B dissolves quickly. The modern version is country A owes a vast constellation of investors, institutions, and citizens, most of them within its own borders. This is the first revelation. The majority of many nations' debt is owed to their own people. When Americans hear that the United States is tens of trillions of dollars in debt, the common assumption is that foreign powers hold the purse strings. But the truth is more prosaic. The single largest holder of U.S. debt is the United States itself. Its banks, its pension funds, its investment vehicles, its state and local institutions, even its central bank. Domestic investors hold the majority. Foreign countries do buy U.S. debt. But they are one group among many, and they are constrained by the same economic incentive that governs all others. U.S. Treasuries are considered the safest, most liquid asset on Earth. Foreign governments do not buy them to control America. They buy them for the same reason an American insurance company does. They are reliable, stable, and easily tradable. If the story ended there, the puzzle would be solved too easily. But the world's debt is vast, complex, and layered, and the role of foreign governments is only a small corner of the picture. The second revelation is that a huge share of global lending is conducted through private creditors, not governments. When a developing nation issues a bond in global markets, the buyers are not typically other countries, but giant investment funds, global banks, hedge funds, and other private sector actors hunting for yield. These private creditors often charge higher interest rates and offer loans without the political strings attached to government lending. But there is a hidden catch. Private creditors are notoriously difficult to negotiate with in times of crisis. A nation that owes $10 billion to one government can renegotiate. A nation that owes $10 billion to 300 different investment funds scattered across dozens of jurisdictions faces a labyrinth. This matters because the composition of a nation's creditors determines how it can survive or fail during crises. When private creditors dominate, interest payments rise, renegotiation becomes harder, and the risk of default increases. When domestic creditors dominate, governments can sometimes pressure or negotiate with local institutions to roll over debt or accept restructuring. When official creditors, international institutions, or foreign governments dominate, political leverage enters the picture. Every creditor type has its advantages and dangers. Every nation lives inside a different mix. Then comes the third revelation. International financial institutions lend heavily, and they do so not as shadowy puppet masters but as lenders of last resort. When a nation faces a balance of payments crisis, when its currency collapses, its reserves drain, its imports become unaffordable, these institutions provide emergency funding. Yet these loans often come with conditions: fiscal reforms, austerity measures, adjustments to subsidies or taxes or exchange rates. Some countries view these conditions as necessary discipline. Others view them as an intrusion into sovereignty. Regardless, these institutions play a central role in global debt dynamics. And now we arrive at the fourth revelation, the part that unsettles people most. Debt is not primarily owed to someone out there. It is owed to millions of investors, savers, institutions, pensioners, and corporations who rely on government debt as the backbone of their financial security. The debt of nations is, in many cases, the asset of their citizens. That which looks like a burden on one side is a source of stability on the other. The world's debt is not a monolith. It is the sum total of people's savings. This idea is difficult to digest because it flips the narrative. We are accustomed to hearing that debt burdens the future. But debt also finances the retirement of the present. Government bonds are the bedrock asset for pension funds, providing steady, predictable returns for retirees. They serve as collateral for banks, liquidity for financial markets, and safe havens for investors. In a world without government debt, the financial system would lose its anchor. There would be no universal reference point for risk-free lending. There would be no place for trillions of dollars of global savings to safely rest. Yet with all this complexity, all this interlocking architecture of global borrowing and lending, the riddle still returns with more urgency. If everyone owes someone, and everyone is lending to everyone else, then what keeps this system stable? What keeps it from collapsing under its own weight? The answer is both simple and terrifying. The system stays stable only as long as people believe in it. Debt is a promise. It is a claim on future money. If lenders believe a nation will repay its bonds, they buy them. If they doubt repayment, interest rates spike, markets panic, currencies fall, and a crisis triggers the unraveling. Debt is sustained not by force, but by trust. Trust that governments will pay, trust that markets will function, trust that the future will resemble the past. This trust is not evenly distributed. Wealthy nations enjoy a privilege that poor nations do not: the ability to borrow deeply, repeatedly, and at lower cost. The global financial system does not treat all borrowers equally, and this inequality shapes everything from economic development to geopolitical alignment. Wealthy countries borrow in their own currencies. Poor countries often borrow in foreign currencies. That difference alone can determine the fate of entire nations, because borrowing in a foreign currency introduces a variable that sovereigns cannot control: the exchange rate. When the local currency weakens, the cost of repaying foreign debt explodes. A dollar-denominated loan becomes more expensive for a nation whose currency has fallen. A crisis spirals. Markets panic. Debt becomes unpayable. And then the question returns more brutally: who is the money owed to? And why does this lending system leave some nations trapped while others thrive? The answer lies in history. Global finance evolved from world wars, colonial legacies, industrial disparities, and the gradual consolidation of certain currencies as global standards. The result today is an ecosystem where some nations are safe borrowers and others are risky borrowers. Safe borrowers pay less. Risky borrowers pay more. But risky borrowers also need capital most urgently because their infrastructure, their economies, and their institutions are still developing. Debt becomes a lifeline and a trap simultaneously. But what about the United States? If every nation owes and lends, where does the United States sit within this global architecture? As a creditor? As a debtor? As both? The truth is that America plays every role simultaneously. It borrows and lends. It is the world's largest issuer of government debt and one of its largest holders of foreign debt. It provides liquidity to global markets through its dollar-based financial system. It attracts foreign buyers to its bond market as a safe haven. It implicitly anchors the world's credit markets through the size and stability of its treasury securities. And it participates in multilateral lending institutions that help stabilize other nations. But the more fascinating part isn't simply that America borrows, it's who lends to America. The answer is not mysterious. It is the American people themselves. Through their savings, their pensions, their insurance products, their retirement accounts, their companies, and their banks, Americans hold their own government's debt. When the U.S. government borrows, the private sector buys those bonds. When the U.S. government pays interest, it is paying interest to American households, American institutions, and American investors. In a sense, much of the national debt is a transfer from one part of the country to another. It is a mirror that reflects internal financial relationships rather than a chain binding the nation to foreign masters. Why then does it feel like a looming threat? Why does national debt trigger anxiety if it is so woven into the fabric of the economy? Because debt is a double-edged instrument. Its benefits accrue gradually, invisibly, through the roads built, the wars avoided, the pensions paid, the recessions softened. Its burdens accumulate slowly, silently, as interest compounds, as fiscal space narrows, as obligations gather. It is not the existence of debt that endangers a country. It is the mismanagement of it. A nation with strong institutions, deep markets, and stable political systems can sustain high debt without immediate danger. A nation with weak institutions and volatile markets cannot. The danger comes not from the size alone, but from the structure. The maturity of bonds, the identity of lenders, the currency of obligations, the interest rate environment, the economic growth rate, the diversification of industries, the ability to refinance, the political stability that ensures repayment. Debt is not a cliff. It is a landscape. Some paths lead to prosperity, others lead to collapse. Picture the world's debt as an interconnected mountain range, each nation on its own peak, the valleys between them filled with rivers of capital flowing through markets, institutions, and banks. Some peaks are sturdy, some crumble. But every peak is part of the range. Every collapse sends tremors. That is why Americans should care about global debt. When a country defaults halfway around the world, it can send shockwaves through global markets. Investors flee risky assets. Funds rebalance portfolios. Capital flows shift. Currencies wobble. The turbulence hits American retirement accounts, American interest rates, American business confidence. The world is too interconnected for crisis to be local. Debt crises spread like electrical failures in a tightly woven grid. But there is a deeper reason Americans should understand global debt. It shapes the world's balance of power. Nations that lend gain influence. Nations that depend on external lenders lose leverage. Nations that issue reserve currencies gain unparalleled advantages. Nations that borrow in foreign currencies must play by someone else's rules. And nations that navigate the system successfully become hybrid creatures, borrowers and creditors, beneficiaries and guarantors of the global financial order. The modern world runs on debt, but debt itself runs on trust, and trust is collapsing in many parts of the world. Political instability, economic inequality, rising interest rates, climate shocks, and shifting alliances are straining the system. Nations are borrowing more to stay afloat. Private creditors are demanding higher returns. International institutions are stretched thin. Some countries are drowning in obligations they cannot meet. Others are stockpiling safe assets because they fear future storms. The question, then, is not just who the world owes money to, but how long this system can stretch before it snaps, and what happens when it does. Because the truth is this: global debt is not simply a financial issue. It is a geopolitical issue, a national security issue, a generational issue, a moral issue. It determines everything from the price of food to the stability of governments. And while it may seem abstract, its consequences are painfully concrete. When a developing nation devotes more to paying interest than educating children, the cost is real. When a middle-income country must slash health spending to satisfy creditors, the cost is real. When a wealthy nation's political gridlock threatens its ability to pay obligations, the cost is real. When rising interest rates make refinancing more expensive, the cost is real. Debt is not imaginary money. It is a claim on future productivity. It is a bet on future stability. It is a contract between generations. So who, ultimately, owns the world's debt? Everyone, and no one. And that is the point. Debt is the connective tissue of the global economy, held in fragments by citizens, institutions, banks, funds, governments, and international bodies. It is too dispersed to topple from a single point of failure, yet too interconnected to be immune from cascading crises. It is both a stabilizer and a destabilizer. It funds progress and perpetuates inequality. It is the world's greatest tool and its greatest vulnerability. But here is the final revelation. Debt persists because it is the price of ambition. It is the cost of building beyond what cash on hand allows. It is the mechanism by which the world brings tomorrow into today. The riddle is not who we owe money to. The riddle is why we borrow at all. And the answer is simple, because every generation wants to build something greater than what it inherited. Debt is the bridge between the present and the possible. The real question is not whether the world is in debt, but whether the world can use that debt wisely enough to make the future worth paying for.